Here are 3 reasons why to subscribe to Fringe Financials on YouTube. Number 1, it is free, which is the best price that you can pay for this kind of content. 2, I am completely transparent with all of my investments. And number 3, I have a variety of educational videos every single week. Now let's get on with the video. What is up, YouTube, and welcome back to another Wisdom Workshop Wednesday. It is Fringe Financials here. In today's video, we get to walk through together the experiences of how to begin to start investing. I have people that come to me and say, Fridge, I don't know how to start investing. I don't know the basics. Where do I start? What can I do? And today's video is going to be walking through all the different avenues you can go, how to get started with it, and how you can give yourself some more returns on your money. If you're excited for today's video, make sure that you subscribe to the channel, smash the thumbs up on the video, and turn on the bell notification. We have just eclipsed 20 subscribers since the last video that I posted. We are now going to be pushing for 30. So we're at 21 right now, and for everyone that is subscribed, thank you so much for the subscription. It helps me continue to make content, and I love doing what I'm doing, and I want to keep providing you guys some very educational information. So what we're going to be doing is we're going to be looking at a couple of the basics and different types of investments, and then kind of diving in from there. So the first thing we want to cover is what is investing. So investing actually means that you are going to be taking your money that you earn from your job or money you get from your birthdays or from holidays or anything that you get money from, and you're going to put that money into assets. Now, the goal of this is to put your money into assets that will give you more money. So taking $10, turning it into $15 gives you even more money, for example. So the focus of investing is to put more of your money that you make into assets and not liabilities. Liabilities, for example, are things like, the brand new iPhone that comes out, name brand merchandise like clothing, tires, cars, those kind of things. Those are liabilities because they lose value over time. And what we want to do is we want to take our money and put it into things that will gain money or make us more money, not lose it. So that's kind of what the focus is of investing. And now assets can range from stocks to bonds to real estate, and you can even start your own business if you'd like to start the investing track. The goal here is to figure out where to go and how you can make more money for yourself. So now, why you should invest is very important. Again, investing is not like a terrifying thing that people freak out about. I know years ago you talk about stock markets and stuff like that, and your parents might be like, oh, don't do that, it's risky, and those kind of things. So investing with your money here allows your money to gain even more money through what's called compound interest. Einstein calls it the 8th wonder of the world. Compound interest is one of those things where it just builds and builds as time goes on, and your money's making more money, which makes even more money, and you get the picture as more and more things compound over the years. All right. And also on top of that, with the compound interest, you also have capital appreciation. So as you invest money into stocks or into real estate, the values of those items themselves will actually go up as well, which is called capital appreciation. So your investments are growing significantly over a number of years. So that is why I think investing is an important thing to know. I don't want you to think that this is a very scary topic and there's so many things to remember here. There's not as much as you think, and we'll dive into kind of just the basics and kind of show you what we can invest in. So, multiple types of investments that you can have. So I'm going to cover 4 types of investments in today's video. The first one, which is one of the most well-known ones, is investing in stocks. Now, if you aren't aware about how to invest in stocks or what investing in stocks is, when you invest in stocks, you're basically buying a partial ownership of a company. So every share or fractional share or anything else, every share that you buy gets you partial ownership of the company. That does not mean that if you buy 1 share of Apple, you now own Apple and you're the next Steve Jobs. That's not even close. But you own this part of a company. So as the company does well, your investment also grows as well. So say you bought a share of Apple at, $100 and it's $150. You've made $50 on this return. So you're investing in a company with the idea and hopes that the company continues to grow. Now, there's things to keep in mind about with stocks. Stocks are volatile. Now, what that means is that prices can go up and prices can go down. Okay. As you're buying a share of a company, there's also on the other end a seller of that share. So there's buyers and sellers. If bad news comes out, for example, say the new Apple phone explodes in your hand, which I hope it doesn't, but say the new Apple phone explodes in your hand and it just decreases all the sales and the value of the phone, you might see a bunch of selling off happening. A lot more people are getting out of the stock because they don't want to invest in it. They don't see it's a good company anymore. So you'll see the price go down. Or say the new iPhone comes out and, a lot of people like the features they offer and it rises the price up. So the news and those kind of things impact how the stock price is going to change. So one thing to be careful with, and just to understand, investing in stocks does mean you're going to have ups and downs. It's not just a straight up rocket ship to the moon. It can go up, it can go down, it can go sideways. So you have to be able to stomach the ideas of volatile markets. Okay. The second type of investment is what is called bonds. Now, I don't know if you know about bonds. I actually have some bonds I was given to from my mom years ago. I guess my family got me bonds when I was 3, and I have a bunch of them they have a 25-year mature period. And I'm getting really close to that, so I can be able to cash in on bonds and I'll make a little bit of money, quote unquote money, but it's not a lot. It's like $50 or something like that. But so bonds basically are loans that you provide to governments or corporations. Now, so what happens here is that the government might say, you know what, you want to buy this bond here. So the bond that you purchase, that money goes to the government to maybe fix up roads, to fix up, companies, to fix whatever you name it that they might want to do with your money here. They take your money and they spend it however they would like. But what they do is they promise you to pay you back the money with interest after a certain period. So say you have a 1-year bond period. At the end of that 1 year, you'll have the money paid back to you. So say it was $100, you'll get $100 back in plus an interest rate of maybe 4% or 5%. And what's good about bonds is that they're more stable than stocks, which makes them a lower risk investment. So there's some investments that have a little more risk to them, and again, higher risk, higher reward. There's also some other investments that you could have that might be lower risk, but you have a more stable return. So you have to kind of find this balance between the two of them. Now, the third type of investment is what's called mutual funds or exchange-traded funds, which is also called ETFs. Now, if you are looking for diversification without buying individual stocks or bonds, so say you aren't quite sure about what's a good company to invest in, is this a good company, is this a good company, and you don't quite know, there's things called mutual funds and ETFs that are great options. What these do is that these are funds that pool money from multiple investors. So it's not just you, it's maybe hundreds and thousands of investors that are putting money into this kind of pool here. And what happens is that this pool gets invested into a variety of assets. So say, for example, you want to invest in 100 different companies, but you're not sure which ones to invest in. You can invest in an ETF or a mutual fund, and they'll invest in those 100 companies on behalf of you. The nice thing about it is that they are managed by professionals, which reduces the risk, and it also allows you to diversify your portfolio. So those are things to keep in mind about. The only thing about mutual funds and ETFs is they have fees that come with it. So you have to be very careful and see what the fees are. Some of them are really small, but some of them can be really, really large. So just keep in mind when you're investing in mutual funds and ETFs that there is what's called an expense ratio that comes with it. So that's money that you got to pay them to actively manage your money for you. So something to keep in mind about, in case you ever look into it. And the last type of investment for today is to talk about is real estate. So real estate is one of the hottest topics every single year, I think, now at this point. So investing in real estate involves buying property with the expectation of the value increasing over time. So if you look at any type of real estate charting all the way back to 1960 or whatever, you'll see that the price of homes always increases. There might be a little bit of a dip here and there, like 2008 had the housing market crash, but housing markets are always going to be increasing as years and years go on here. So, a house worth $100,000 back then is now worth maybe $200,000 now. The good thing about real estate also is that it can provide rental income and also has a lot of tax benefits. So rental income, again, you can buy a house and rent it out to other people and they can pay your mortgage for you. So you don't have to even pay the mortgage on it. And there's also a bunch of tax benefits, like write-offs and those kind of things that you can also have to save you some money in the long term. The only thing about real estate is that it does require careful research and management. You can't just buy a house and then just set it and forget it and just let it go, because if something breaks, you are responsible to fix it. And if you buy a house and you pay over asking, that means you've lost some profits that you might get in the long term because you overpaid at the initial part. So real estate is a good investment to look into, but again, it does require research and management. Well, that is it for today's video. I hope you guys learned something new about the basics of how to start investing. Again, any questions you have of financial education, please feel free to drop them down in the comments down below. On Friday, I will have a big announcement. Now, I will give you a little bit of a heads up. I'm not going to do a net worth review Friday because I have a huge announcement. I'll explain why on Friday. So if you're looking forward to that announcement, make sure you stay tuned to the channel. Make sure you subscribe to the channel if you haven't already done so. Like the video, turn on the bell notifications. I hope you guys all have a great rest of your day, and I will see everybody on Friday.